There is a specific balance in your retirement account where the math quietly flips, where a normal year's growth can become larger than everything you put in yourself. Most people cross that line without ever realizing it. Ray Delgado had been sitting on that line without knowing it. The statement had been sitting on his kitchen table since Thursday. He opened it Sunday morning, the way he'd opened one every February for 18 years, expecting exactly what he always found, a number that had moved because he'd pushed it. He didn't get up for a while. His wife asked him twice whether something was wrong with the account. Nothing was wrong with the account. That was the strange part. He went and dug out the previous year's statement and the one before that and spread all three across the table. Because what he wanted now was to find the exact year the pattern had broken. There was no windfall anywhere in those pages. No inheritance, no promotion, no lucky stock he'd forgotten he owned. Ray had never made a single interesting financial decision in his life. He'd put the same slice of the same paycheck into the same unremarkable account, month after month, through 2 kids, a roof replacement, and one stretch in 2020 when he wasn't sure the school district was going to keep him. What he had walked into, without any idea it was coming, was a threshold, a specific balance, one you can work out in about 40 seconds using 2 numbers already sitting in your own account that quietly splits an investing life into a before and an after. He'd crossed it, and he'd crossed it a while ago, without ever noticing. The reason he sat there until the coffee went cold had almost nothing to do with how much money he had. Ray is 47. He runs facilities for a public school district outside Columbus, heating systems, roofs, the contractors who show up when a pipe bursts over Christmas break. He makes $86,000 a year. He puts 15% of his salary into his 403B, about $13,000, and the district kicks in roughly $5,000 more, call it $18,000 a year going in. He's done some version of that since 2007. He is, in other words, completely ordinary. Not rich, not reckless, not behind. The kind of person who does the responsible thing for long enough that it stops feeling like an accomplishment and starts feeling like a chore. And for most of those 18 years, his instinct was exactly right. Early on, you are the entire engine. Run the numbers on the version of Ray who's just getting going. Say he's built up $40,000. If that money returns 7% in a year, and I'll come back to how much weight that number can actually bear, it produces about $2,800. Against his $18,000 contribution, the portfolio is doing roughly 13% of the work. He's doing the other 87%. That's not a compounding failure. That's just arithmetic. 7% of a small number is a small number. At that stage, if Ray wants the balance to move, the only real lever he has is his own paycheck. Skip a year of contributions, and the account barely grows at all. Ray remembers those years clearly, and not fondly. He remembers checking the balance in his 30s and doing the mental division. How many years at this rate to get anywhere, and coming up with a number that felt like a prison sentence. He remembers his wife asking, more than once, whether the money might be better used on the house, and not having a good answer beyond the fact that he'd promised himself he'd keep doing it. The account felt less like an investment and more like a jar he was filling one coin at a time, with no evidence the jar was doing anything other than holding coins. He wasn't wrong about that. At $40,000, the jar really was mostly just holding coins. What he couldn't see, and what nobody sat him down and drew out, was that the jar's behavior was going to change. Not because he'd change, but because the thing inside it would eventually get heavy enough to matter on its own. This is the stage where nearly every piece of financial advice you've ever heard was written for. Save more, cut expenses, get the match, raise your rate, all of it correct. All of it aimed at the one lever that matters when your capital is small. But here's what almost nobody explains. That lever doesn't stay the most important one. Move Ray forward. He's got $150,000 now. Same $18,000 going in, same 7% assumption. The portfolio's expected growth is $10,500. His contribution is still bigger, but not by much. The account is now doing about 37% of the work. Nothing about Ray changed. He didn't get smarter, didn't pick better funds, didn't discover some strategy. The only variable that moved was the size of the pile the percentage is acting on. And once you see it that way, you can find the exact point where the two forces meet. Here's the whole thing, and it's simpler than it has any right to be. Take what you put in every year. Divide it by the return you're willing to assume. That's the balance at which one ordinary year of expected growth equals everything you personally add. For Ray, $18,000 divided by 0.07. That's $257,143. That's his number, not a milestone somebody handed him, not a round figure off a magazine cover. a number that falls directly out of his own contribution and his own return assumption, and one he could have calculated in about 40 seconds at any point in the last 18 years. At $257,000, the money he already has is expected to generate as much in a year as the money he's still adding. Below that, he's the majority shareholder in his own progress. Above it, he isn't anymore. And now watch what that formula does when you change the inputs, because this is where it stops being Ray's number and starts being yours. Somebody putting in $10,000 a year at that same 7% assumption crosses at about $143,000. $15,000 a year crosses at $214,000, $20,000 at $286,000, $25,000 at $357,000, $30,000 at $429,000. Notice something uncomfortable in there. The more you save, the higher your crossing point. Somebody stuffing $30,000 a year into their accounts has to build a much larger portfolio before the portfolio catches up to them, not because they're doing worse, but because they're a stronger engine themselves. Two people can be equally on track and hit this point at wildly different balances, and the return assumption moves it just as violently. Keep Ray's $18,000 fixed and change nothing else. At 8%, his crossing point is $225,000. At 7%, it's $257,000. At 6%, $300,000. At 5%, $360,000. Same person, same savings, a $135,000 swing in where the line sits, driven entirely by a number nobody can actually know in advance. Which brings up the thing I need to say plainly before this goes any further, because the whole framework collapses without it. 7% is not a promise. It's a planning assumption. Roughly what a diversified U.S. stock portfolio has returned over long stretches of history after inflation. It is not what any given year delivers. In 2008, the S&P 500 fell about 37%. In 2022, it fell about 18%. There are years in between where it ran up 25% or more. The average is real. The smoothness is fiction. So when I say a portfolio generates $18,000 at $257,000, I mean something narrow and specific. That's the expected value. It's the center of a very wide distribution, not a payment schedule. There's a second trap buried in that 7%, and it catches people who think they're being sophisticated. You've probably heard that stocks return about 10% a year. That figure isn't wrong. It's the long-run nominal number, before inflation. And if Ray runs his threshold with it, he gets a very different answer. $18,000 divided by 0.10 is $180,000. He'd have concluded he crossed the line years earlier than he did. But nominal dollars don't buy anything. They buy whatever inflation leaves them buying. The 7% figure is the same market with inflation stripped out, and it's the one that corresponds to actual purchasing power. The only thing a retirement account is really for. Using the nominal number makes your threshold look $77,000 closer than it is. It's the most flattering possible way to run the math, and it's the one people reach for without thinking, because bigger returns feel like better news. And right now, that distinction is doing more work than usual. As of this summer, the Shiller-Cape ratio, the S&P 500 priced against 10 years of inflation-adjusted earnings, is sitting north of 40. Over roughly a century and a half of data, it's only been higher during the peak of the dot-com bubble. Vanguard's own capital markets model, run at the end of 2025, put expected U.S. equity returns at somewhere between 3.9% and 5.9% annualized over the following decade. Not a crash call, just a lower center of gravity than the historical average most people default to. If you plug 5% into Ray's formula instead of 7%, his line moves from $257,000 to $360,000. He isn't as far along as the cheerful version of the math would suggest. That's worth knowing, but he had, in fact, crossed it. By the February, he sat at that table. Ray's balance was right around $300,000, past his 7% threshold, right at his 6% one. The market had returned about 8% that year. 8% of $300,000 is $24,000 against the $18,000 he'd put in. That's the whole reveal. There's nothing mystical in it. His money had simply gotten large enough that an unremarkable market year moved it more than his salary could. Here's the part Ray got wrong for about a week afterward, and it's the same part most people get wrong. He started thinking of it as a finish line. It isn't. It's a handoff, and the handoff comes with a problem attached. If a portfolio is big enough that a good year beats your contribution, it is by definition big enough that a bad year does too. That's not a caveat. It's the identical equation with the sign flipped. Raise $300,000 in a 10% down year loses $30,000, nearly 2 years of everything he puts in. In a 2022 type year, down 18%, it loses $54,000, 3 full years of contributions. In a 2008 type year, down 37%, it loses $111,000. More than 6 years of his savings, erased in 12 months, by a market doing something it has done before within his own working life. He cannot save his way out of that. That's the actual consequence of crossing the line. The engine that starts doing the heavy lifting for you is the same engine that can run you over. And once you're past the crossover point, your paycheck is no longer big enough to be the counterweight. And there's a wrinkle in that which almost nobody anticipates, because it doesn't occur to people that the line runs in both directions. Suppose the year after Ray's February at the kitchen table, the market drops 20%. Not a catastrophe by historical standards, the kind of decline that shows up every decade or so. His $300,000 becomes $240,000. He's lost $60,000, more than 3 years of contributions. But look at where that leaves him relative to his own threshold. His crossing point was $257,143. He's now at $240,000. He is back underneath the line. The portfolio that had just started out earning him is, temporarily, no longer large enough to do it. He hasn't been demoted. Nothing about his discipline changed. The market simply pushed him back across a boundary he'd only recently cleared, and it would take roughly a year of ordinary returns, plus his usual contributions, to get back over it. That's the part the tidy version of this story leaves out. You don't cross the threshold once and stay across it. You cross it, and then the market decides, repeatedly, whether you're still on the other side, which means the job changes. Before the threshold, the question is, can I put enough in? It's a question about income, discipline, and expenses, and the answer is mostly within your control. After the threshold, the question quietly becomes, can I avoid doing something expensive with what I've already built? And that question is almost entirely about temperament. There's decent evidence on how well people handle that second question. Morningstar runs an annual study called Mind the Gap that compares what funds return to what the average dollar invested in them actually earned. Over the 10 years ending in 2024, U.S. funds returned 8.2% a year in aggregate. The average dollar in those funds earned 7.0%. The 1.2 percentage point difference comes from the timing of when people put money in and pulled it out. About 15% of the total return, gone. Not to fees or bad funds, but to the pattern of getting in and out. Now apply that to Ray. Before the threshold, a behavioral slip cost him a percentage of a small number. After, it cost him a percentage of a number bigger than his annual savings. Same mistake. Different price tag entirely. This is why the psychology has to change along with the math, and why so many people cross the line without ever adjusting. They've spent 15 or 20 years training themselves to think about contributions, and the habit doesn't update just because the arithmetic did. What should change is less dramatic than it sounds, and it depends heavily on who's asking. A 35-year-old with $300,000 and a 30-year runway can absorb a 37% drawdown, painfully, but genuinely. Time is the thing that repairs sequence risk, and they have piles of it. A 62-year-old with the identical $300,000 does not have the same luxury. If the market hands them a brutal stretch in the first few years of drawing on that money, they're selling shares into a decline to fund groceries, and that permanently reduces what's left to recover. Same balance, same threshold, completely different set of correct decisions. Where the money sits changes the arithmetic too, and this is the piece people skip entirely. Ray's $300,000 is inside a 403B, which means nothing gets taxed along the way. His 7% assumption compounds untouched until he withdraws. But run the identical threshold for somebody holding that balance in a regular taxable brokerage account, throwing off dividends and the occasional capital gain distribution that get taxed every April, and the effective return is lower. Not dramatically, but enough. Knock a single point off, from 7% to 6%, and the crossing point moves from $257,143 to $300,000. Knock it to 5.5%, and it's $327,000. I'm not going to tell you what your drag is, because it depends on your bracket, your state, your holdings, and how often anything gets sold. And anyone who quotes you a universal figure is guessing. The point is directional, and it's reliable. The threshold you calculate is only as good as the net return you plug into it, and the return you actually keep is the only one that counts. So the honest version of what changes after the line, is a set of questions rather than a prescription. What's the allocation actually holding? And does it match the horizon rather than the habit? How much is going to fees now that fees are being charged against a bigger base? Is there enough cash outside the portfolio that a bad market and a bad month don't have to be solved with the same dollars? For someone approaching withdrawals, what's the plan for the first 5 years? The stretch where sequence risk does the most damage? None of those questions were urgent when the balance was $40,000. All of them are now. Not because the portfolio got dangerous, but because it got consequential. And then there's the last mistake, the one hiding inside the title of everything ever written on this subject. Crossing the threshold does not mean you're done contributing. Ray's $18,000 didn't become worthless the day his portfolio out-earned it. It became the smaller of two engines. And the smaller engine is the one he still controls. Market returns are a distribution he has no vote in. His contribution is the one input he can guarantee. In a year, the portfolio drops 15%. His $18,000 is the only thing on the page moving in the right direction. Over time, continuing to add does something the math above doesn't capture. It shortens how long he's exposed to needing any particular decade to cooperate. It's not that the contribution matters more than compounding. It's that it's the part of the equation with no uncertainty in it. And giving that up because a spreadsheet said the other engine is bigger is trading the reliable lever for the unreliable one. There's also something worth noticing about the shape of what comes next. At $257,000, Ray's portfolio does about half the work. At $500,000, that same 7% assumption produces $35,000 a year, roughly double his contribution, meaning his money is doing about 2/3 of the lifting. Getting from the first number to the second, at his savings rate, takes him somewhere in the neighborhood of 7 or 8 years, assuming markets behave close to the long-run average, which they may not. The point isn't the timeline. The point is that the ratio keeps tilting, and it tilts faster the further along you get, without you doing anything differently, which is a strange and slightly disorienting thing to sit with when you've spent 2 decades believing the whole structure rested on you. Ray still contributes his $13,000. The district still adds its $5,000. From the outside, absolutely nothing about his financial life looks different than it did the February before. What changed is that he knows which number he's actually watching now. He knows his crossing point was $257,000 at a 7% assumption and $360,000 at a more conservative 5%, and that the truth is probably somewhere in between and unknowable in advance. He knows a 30% market decline would cost him more than 5 years of saving, and that no amount of extra discipline at his income would offset it, which is a more useful thing to understand at 47 than at 65. And he knows that the version of him who spent 18 years believing every dollar of progress had to come out of his own paycheck was right for about the first 12 of those years and quietly wrong for the last 6, without ever once checking. That's the actual value of the number. Not that it's a threshold you unlock, it's that it tells you which stage of the game you're standing in, because the correct behavior on one side of it isn't the correct behavior on the other, and the arithmetic won't announce the transition. It just happens, in some ordinary year. In a growth column, you probably don't read that closely. Your number is your annual contribution divided by whatever return you're honest enough to assume. It'll take you about a minute. Most people never run it. They just keep saving, keep hoping, and never find out whether they're still the engine or whether they stopped being the engine years ago and nobody told them.